Hello everybody. Firstly, I'd just like to welcome you to this webinar. We'll be talking about the US-China trade conflict, the possibilities for a first phase trade deal, and the continuing trading opportunities that have and will come about as a result. My name is Sasha, and I'm a financial analyst from the research department at Trade. If you have any questions, please call us and ask to speak to a senior account manager who'll be happy to help. So before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. Now, first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimates on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's solely your decision whether you trade on market opportunities or not. So here's an example of a market opportunity. You can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the partner situation in Italy, which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment, in our estimation, for opening a trading position, had you decided to trade on this opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further down. At these points, you can put a stop loss and take profit. On the right-hand side of the screen, you have calculations. If you close the position using take profit, you can expect the kind of profits at the support levels in green. If the price is going against you, you can potentially have a loss of the amount at the resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. So, a brief history of the US-China conflict. A potential conflict has been brewing between the US and China for some years now. There's been a recognition among economists, politicians, and the wider public that it's a matter of time before China challenges and then overtakes the US as the world's most dominant economy. The US does not want to give up the title and has been hyper-vigilant on how it believes that China is taking advantage of the US. President Trump and others have long accused China of stealing jobs from the US economy. This simplistic accusation goes down well with the public. However, there is a better argument regarding the theft of US intellectual property, basically involving Chinese companies stealing ideas and designs from a successful US product and creating their own cheaper version. The US is also very concerned about the trade deficit they have with China. It should also be noted that US politicians from all sides support the revision of trading terms with China. Where they disagree is what measures should be used and how hard a line the US should take. Since the trade war officially began in June 2018, the US has slapped tariffs on 550 billion worth of Chinese products. Since the trade war officially began in June 2018, the US has slapped tariffs worth some $550 billion worth of Chinese products. China, in turn, has placed tariffs on $185 billion worth of US goods. So how has the trade war impacted the markets? You can see here stocks negatively impacted, crude oil negatively impacted, the dollar positively impacted. The trade war has provided support to gold and the Japanese yen. Remember, these general rules are about negative sentiment on the trade war, when talks break down or if new tariffs are announced. Progress in trade talks, or the delaying of tariffs, tends to have the opposite effect. Crude oil should rise, stocks should go up, etc. In a moment, I will show you how exactly the trade war has affected crude oil prices, stocks, and gold. But let's get up to date on what is happening now and how this has affected the instruments you trade with. Progress in on-off negotiations between the US and China has been slow. Most notable progress was made in December 2018 when the US and China negotiated a temporary truce of 3 months as the two sides worked towards a deal. The 3-month deadline was extended on February 24, 2019, when President Trump announced that the deadline would be extended. After months of talking, on May the 5th, Trump threatened increasing tariffs, and both the US and China added additional tariffs in the following months. In June, the US and China agreed to reopen trade talks, which were followed by more tariffs. But on September the 5th, China and the US agreed to talks again. After lower key talks, the US and China have parked some major issues for a later day and have decided to focus on a mini or first phase deal with a view to reaching a full deal next year. Such a deal would likely involve the scaling back of existing tariffs and a Chinese commitment to purchase between $40 to $50 billion of US agricultural products. However, the Asian Pacific meeting was cancelled on October the 30th, with host Chile stating it was unable to hold a safe summit due to mass protests in the country. Latest reports suggest that the US and China are more likely to sign the deal in December, with no specific date cited. Despite some progress, there are disagreements, even within the US negotiating team, on whether or by how much existing tariffs should be reduced or cancelled completely. So let's take a look at the three instruments, the S&P 500 or USA 500, gold, and crude oil. As I mentioned a moment ago, in December 2018, a truce and suspension of tariffs were announced. You can see here how stocks reacted, skyrocketing almost 22%, and then reversing direction after new tariffs were imposed by the US, to which of course China responded. You can also see on the right that the index has powered ahead by over 6% to an all-time high since new talks were announced. As most of you know, gold is a safe haven instrument, so we would generally expect gold to rise in times of uncertainty and potential economic difficulties. You can see clearly here on the left is the line marking the announcement of new tariffs in May this year. Gold skyrocketed by nearly 22% until the beginning of September, when US-China trade talks were announced. Since then, gold prices have fallen. Crude oil prices are also very much affected by the trade war, since an extended trade war will negatively impact the global economy, which will reduce demand for crude. But other demand and supply factors impact crude as well, so crude movements aren't as clearly correlated with the trade war. But you can see here how after new trade talks were agreed in September, that crude prices jumped up to 16% over the next 2 weeks or so. After the first phase deal was proposed on October the 10th, you can see another clear reaction from crude oil, which has pushed 6.75% higher over the following month. The trade war has rumbled on for many months now, and at times it can be difficult keeping up with events. However, it is possible to trade the trade war if you keep your eye on the ball and have somebody to keep you informed. The example of the charts I've shown proves this. The trade war has a direct impact on the instruments you trade with. Yes, there are other factors that influence prices, such as the earnings season for stocks, interest rates, or economic data. But it helps to keep yourself informed about this as well. Well, I hope you found this webinar useful. Of course, at ForTrade we will be following developments related to the trade war. It's probably fair to say that we follow the trade war more closely than any other geopolitical event at the moment, because of its dramatic impact on many instruments. Please do get in touch with your senior account manager for further information. Until next time, goodbye. Please join us again at ForTrade soon.